Good morning, good afternoon, good evening around the world. My name is Doug Brunke. I'm the founder and CEO of Global Chamber. This is a bit of a magical Globinar in the sense of it came together in an extraordinary way, and it also includes some really extraordinary people. It started, I believe, with Alex Martin visiting Phoenix on a cold, bitter cold December, January actually, day from Detroit, when it turned out to be quite as a normal January wonderful day in Phoenix. And through his meetings in Phoenix, he started to connect up with some other extraordinary business leaders who are working internationally, including the Bank of America team, including Spencer Fane team, and including the Fleischman team. And so we started to talk about the Global Semiconductor Summit that Global Chamber held in February, which had hundreds of people. It was extraordinary and amazing. And we were thinking, gee, these companies landing in Phoenix, or actually companies landing anywhere, they often make mistakes. They don't know who to turn to. They could benefit from some tips and techniques in a variety of areas, including legal and banking and transfer pricing and tax and accounting, et cetera, et cetera. And so why not pull together a few experts to talk about that, landing in a new country, and particularly with Phoenix and the semiconductor industry, at least initially, in mind. And so that's what we're doing today. We're just having a conversation for exporters and people who are growing business across borders to be connected to extraordinary leaders and for them to receive tips and techniques. We can't possibly connect every bit of information that you need to be successful, but we can connect you to the right people, and they can connect you hopefully today with some pieces of information that you either didn't know or definitely need to know, and you'll have their contact information as well. So let's start with Alex Martin. Alex is a transfer pricing expert at KBKG. He's going to lead us off. We've got 4 blocks of 10 minutes. First with Alex, we're going to then switch to the other 3 segment speakers, and then we should have time, about 15 minutes at the end, for Q&A. If you have questions, please feel free to put them in the chat area so that we can be all prepared. Also, at the end, if you're a member of Global Chamber, we're happy to take your question live, unmute yourself, and we'll be happy to do that as well. Also, feel free to put your information in the contact area. So without further ado, let's go to Alex. Alex, where are you zooming in from today? And teach us a little bit more about transfer pricing and also kicking us off today.
Sure. I'm calling in from Plymouth, Michigan, where it's a wonderful couple degrees above freezing. Hey, again, thank you so much for joining. As Doug mentioned, we were putting our heads together with this Global Semiconductor Summit, and we were thinking, well, there are so many great companies coming into, in this case, Phoenix, which all involves establishing or completely restructuring their supply chain. But we were thinking, we come across companies every day that are struggling in paying for those supply chain restructuring items. And if we can offer some practical insights from working with companies that's similarly situated, that can really make a big difference, because whether it be reducing cost all the way to delivering faster to customers, all these things cost money. But if you can set yourself up correctly, or if you can set yourself up from a legal, tax, or banking perspective, you're going to be a lot better shape than if you're just winging it. So what I thought we'd start with is Bank of America has a magnificent supply chain disruption survey that I thought Vince and Karen could talk through, and then we can talk about specific tax, legal, transfer pricing issues before finishing things up with some other banking advice. So we're going to talk about common examples of misaligned tax and legal strategies, some savings from structuring correctly, and really some best practices just to touch on for some takeaways for today. So with that, let's jump into the supply chain disruption study.
All right. Good morning. Vince Thelander with Bank of America. I'm a market executive here in our business banking team, which works with emerging companies, kind of small, mid-sized private companies. Many of them are fairly new to importing or exporting. Some are more established, but typically established maybe to one or a couple of countries. So we spend a lot of time just guiding, advising, helping really manage risk. So what do banks do well? We help manage risk, and we provide and advise on access to capital. So it would be impossible to cover a whole lot of that in 10 minutes, so we'll focus on a few key points. We'll set the foundation with this supply chain study. It's actually not from Bank of America, it's from Logistics Management, but we cite it, we talk about it, and we're presenting it today. So let's talk about it. So right away, you can't help but see that nearshoring or reshoring is very much a priority, with top destination markets of US, Mexico, and Canada. You can see the impact of the difficulty getting product out of Asia the last couple of years. Companies lost sales, they sacrificed margin because they had to, use air freight instead of sea, which is a lot more expensive, but they did it to protect customer relationships. IP theft has always been a concern. There's been, it kind of came to a head over the last couple of years, really, when you're losing sales and when you're disrupting your clients, it's impossible to not take note. So it cut deep, right? Companies are thinking about, okay, that happened. We need to prevent against that situation from happening again. What's interesting, however, is 66% of respondents, or 2/3 of the respondents, said that emerging markets are still somewhat or extremely important to global sourcing strategy, including Asia being #1. So this is clearly a medium to long-term strategic change. This is not something that companies are planning to do overnight. It's going to take time, and they recognize that. This is an opportunity a lot of companies are revisiting. They're thinking about it differently. They're evaluating the options. They're looking at different countries. They're evaluating the risk. It takes time, it takes money, and it takes good advice. Okay, let's go to the next slide. What we think is really interesting here is this is a measure of the pressures on the supply chain. So very clearly you can see the pressures during the pandemic, but you can see that they've really eased up markedly in February. So the shipping, the ports have largely freed up, capacity and over the road trucking, rail, it's freed up significantly. There's more storage available. It doesn't mean that everything is back on track, right? The damage has been done, but largely right now, companies are in a pretty good place for their supply chain. So that's basically where my comments on this couple of slides are going to end, and Karen Bottesch on my team is going to take over with some additional information.
Thank you, Vince. Okay, so in the spirit of the collection of data, to the point of the damage has already been done, several Wall Street articles talked about what CFOs and finance professionals are doing. So while the urgency to nearshore may be a bit subdued now, a lot of things have still changed. I mean, we all know that there's a preference to rely less on Asia, particularly China. The move away is just starting. Businesses are trying to figure out how to do that. It introduces new sets of costs, logistics, hurdles around a nearshoring strategy. Not going to happen overnight. And although China is losing market share to countries such as Mexico and Vietnam, they remain the global manufacturing leader. Their advantage, the big advantage, is that they have a network of suppliers already established. They already have the ecosystem. That's what has to be replicated elsewhere. So that work includes bringing suppliers in from new geographic regions, finding suppliers closer to the end use location, moving away from single sourcing, make supply chains more resistant to disruption, source critical components closer to home. That's a big one. And there's a lot of discussion about adding and implementing the use of automation and technology to keep the shop running. There's a decision point. Does the company want to minimize risk or minimize cost? Highly recommended to be nimble, have relationships, and pivot. I saw examples of that during COVID, where a manufacturer had other suppliers, relationships at the ready, and she was able to pivot and move from China to Italy when we were all going through the COVID event. Since the supply chain costs are the single biggest line of COGS, financial professionals are spending more time with their supplier issues. So on this slide here, I know there's a lot of information. So there's, there's interest rate risks that feed into the economy and financial markets today in terms of, acquiring new equipment and putting some of these structures in place. There's the geopolitical risk to consider, a lot of commentary around cyber attacks and getting protection. Companies, they seem to blame other departments instead of getting something in place. Mexico is taking steps to build out an ecosystem. I think that will continue over time and become more and more important to the US. And I think under climate risk, businesses need to map out what their supply chain strengths and weaknesses are. On the next slide, again, a lot of information here, just a few highlights. 58% of those that responded are more concerned about disruption causing short-term loss. 53% rated working collaboratively with their suppliers as one of the most important topics. Poor data and transparency being roadblocks. What's going to improve that is relationships. Relationships foster increased transparency. If you have a good relationship with anyone, they're going to share more information with you. Again, they mentioned cyber risk as a top risk factor, protecting business email, protecting the environment. And I will pause here and I believe turn it back to Alex.
You. So let's, now that we've set the stage with some of the supply chain issues that companies are facing, let's talk about some of the tax and legal issues that are certainly top of mind when it comes to Michael and Dale's perspective. Let's see. Gentlemen.
So these are some initial considerations, which we'll talk about a little bit more in detail in next slides. But I think the first and foremost thing, once you've decided on a country, is what type of entity structure are you going to have? The US has some entity structures that other countries don't have, an LLC. Not every country has an LLC type entity. And then other countries have entities the US doesn't have. Then who will own the entity? Will it be individuals or businesses or whatever? Of course, one thing to keep in mind is treaty. Most of the countries in the world have a treaty with the US, not all, however, and some that may actually surprise you. At least they surprised me. For example, Brazil does not have a treaty with the US. I would thought Brazil would have, but they don't. And then one time or another, sometime, whether it's during their operations or a death or some point, they will have to repatriate those profits back to their home country. And what's the tax on that? And then the big one, if you have a foreign group looking to expand to the US, they create a business or buy real estate or whatever, that is subject to non-resident US estate tax. But there are ways to get around that.
Dale, could I
Please do.
jump in a little bit, and then we'll and we can go to the next slide. But one other consideration, Dale and I often are on a call with an inbound client talking tax and legal together. One thing that also comes up in this conversation is when you're determining whether it's going to be the two individuals that own the Singaporean company parent or that own the Brazilian parent or the Mexican parent, whether they're going to create an entity here where the two of them are going to own it, let's say, as an example, just like they own the Brazilian, or whether the Brazilian entity or the Mexican entity or the Colombian entity or the Belgian entity are going to own this entity directly, 100% parent, mother, sub, as we call it sometimes. Another issue is, what are going to be your immigration needs in the future? Are you going to try to establish that you've put enough into this that you can get a investor visa like an E2, or are you going to try to tie it to this mothership so that you can do L1 transfers in the future? And then Dale, I would say on the repatriation side, he mentioned that is a key issue. There's 9 ways from Sunday to get your money back to Brazil or to Belgium or to Singapore, and you might be loaning to your subsidiary, you might be doing a license of intellectual property in the name of the company, using the same name in the US, licensing that. You might be doing consulting where certain key individuals consult to the on loan from the parent company. You may purchase real estate or warehouse. You may send equipment into the US that manufactures or that packages or whatever. And Dale is a good expert on as structuring a lot of these, and there are documents that go along with those. And then we immediately turn to the Alexes of this world and say, hey, there's this thing called transfer pricing that you have to need to be concerned about the interest rates but under the tax treaty, there will be different categories at times of taxation for each one of those repatriation activities. So we talk to the client about, planning will help you. So Dale, back to you. Sorry.
No worries. That was great. I guess the point here, especially entity structure, most of the people I talk to think they have an idea of what they should do, and it turns out they're almost always wrong. They do their expert research on the internet and find an answer. Well, sometimes the answer is just flat out wrong, but most of the time it's right in a certain circumstance, but not in their circumstance. So you have to go through all these questions and figure out what's right for the client. And next.
And Dale, can I add there? Most people are talking about either an LLC or a corporation, and they're asking about, should I be a Delaware entity? In some cases, yes, and then but you'll need to what we call foreign register in Arizona, California, Texas, wherever you have operations. You're going to need to also, and that's very simple, can be done in a day with most jurisdictions. But there is another issue, Dale, you may want to comment on too. People will talk about, on the tax classification of either an LLC or a corporation as a flow-through entity, such as an S-Corp. S-Corps cannot be, having foreign ownerships directly can destroy that ability to use that S. However, foreign persons can be owners of both corporations and LLCs. They just may not have the tax flow-through treatment unless we do it right that they're looking for. Dale, you
Right.
want to
As
comment
an
on that?
example, Canada does not recognize the flow-through nature of an LLC. So if a Canadian started the business using an LLC, while it would be a flow-through in the US, it would be taxed as a corporation in Canada, and you end up with double tax. Well, you say, well, you could always elect to have the LLC taxed as a corporation. That's perfectly true, but then why not just start with the corporation to begin with? But anyway.
So, and just to interject there, so effectively, the structure of the U.S. entity in this case doesn't just affect how much tax you're paying in the U.S. It also has a flow-on effect to other countries, the parent company, what have you, and all of those things. If you can if you can select the right structure for your specific operations, that's going to make a heck of a difference, not just now, but years into the future.
Definitely.
If I could add to
avoid double taxation.
Yes. Dale, if I could add too, you say there's several legal documents important. The language of the documents between LLC, which are very well, I mean, they've been around since the 1950s. They're very well established. They have the same protection as a corporation in most, in almost all instances from a legal standpoint in terms of limited liability. But the language of LLCs is different. Instead of officers and directors, you have managers, but that's very well respected. And then also an operating agreement, articles of organization, operating agreement. In the corporation side, you have certificate or articles of incorporation, bylaws, and a shareholder agreement. But trust me, the documents do the same thing. They're very flexible on the LLC side, but basically, once you get with Dale and figure out which one I want to be for tax purposes, we can accomplish it from the legal side.
Yeah, I think I briefly covered this. A tax treaty is designed to prevent double taxation and avoid tax evasion. It outlines what country gets to tax what income. Every treaty is different. Just because you know one treaty, I know Canada-US treaty pretty much inside and out, but that doesn't mean all that means is I know Canada-US treaty. That's all it means. You can't take that and run with it. So you have to look at every treaty separately and figure out what its nuances are. And remember, not every country has a treaty. So sometimes we recommend, if they're in a non-treaty country, to establish a business in a treaty country and then to have that entity in that treaty country be the owner of a U.S. entity.
So effectively, the tax treaties facilitate investment and also cash movement. So you're in a better position to, effectively improve the efficiency of your
They facilitate in the fact that they make the rules clear and they help to avoid double tax. And this is a big one that almost no one knows about as far as people coming to the U.S. Either they get it wrong in that, Canadians are aware of the U.S. estate tax, but they get it wrong and they think that their entire net worth is subject to the U.S. estate tax, which would be incorrect for non-resident. Only their U.S. assets would be subject to non-resident tax. And the other would be they're completely oblivious to it and don't have any idea it even exists. So one important thing to always bring up is how will they be subject to the non-resident U.S. estate tax and how can they avoid it? So the estate tax of flat 40% for non-residents to just be on their U.S. assets. So there'd be their partnership, their corporation, their real estate, whatever, unless that U.S. corporation is a wholly owned subsidiary of a foreign corporation. That is 100% foolproof. That would be not subject to U.S. estate tax. Another probable way of avoiding that is through a foreign partnership owning a U.S. partnership. In theory, that should all work. The problem is, the hesitancy is that it hasn't been proven in court. There's been no court cases to say that we know definitively that this will work. But everyone is pretty certain, like 90+%, that it will work. It's not certain is all.
So with that, let me jump into transfer pricing real quick. Just a quick example, and I'll borrow, since we've been talking about the Taiwan Semiconductor recently with Phoenix. Let's just say we've got a Japanese parent company that is selling silicon wafers to a new US subsidiary that's helping install and sell semiconductor components to in the US. Well, the price you charge on those silicon wafers is going to drive how much tax you pay in Japan versus the US. If I charge too high a price, the IRS is unhappy. If I charge too low a price, the Japanese tax authority is going to be unhappy. So that transfer price is a big concern, not just of these two tax authorities, but effectively 100+ countries worldwide enforce these transfer pricing rules. This is important from a company perspective in that it's also going to drive your global effective tax rate. So more taxes in Japan, in this case, is going to be a higher tax bill than perhaps in the US. The other thing I'd like to emphasize is that transfer price also drives where cash ends up within the organization, and that's especially important when it comes to supply chains. Let's dig a little deeper. Well, we're just talking about silicon wafers, but it really doesn't matter. Every multinational company has a transfer pricing issue. Goods, inventory, services, royalties, loans, what have you. The price you charge on those transactions is going to drive how much tax you're going to pay. And so governments, they may not know much about you, but they do know how much tax you're paying. So if a company doesn't have their transfer prices correct, well, there's going to be too little tax paid in certain countries. Now, right, maybe you're not paying a lot of tax in country X, but you're probably overpaying tax in somewhere else. So and if you are audited for transfer pricing, there are significant audit risk. You pay additional income tax penalties and actually a double tax situation. So, but from a cash flow perspective, incorrect transfer prices also affect where cash ends up within the organization. So you may be in a situation where you don't have cash to make your investments in a new plant, for example, or you may not have enough cash in the parent company to do R&D. So these are all important questions to get your arms around, because there's a tax issue that comes into play. And then, well, if you don't have the transfer prices correct, you may have some other issues that's going to increase your borrowing cost. Let's take for an example. Let's take we've got a situation like we're talking about, Japan parent, US subsidiary, and the US subsidiary has a loss of $5 million on $100 million in revenue. Now, the IRS is going to have a little heartburn over that because they don't like to see foreign-owned subsidiaries incurring losses. And on the parent side, the Japanese tax authority is quite happy with them because they're earning $3 million in tax over in Japan. Well, so effectively, if there is a loss, in this case of $5 million, if you continue to incur losses, at some point, you're going to have a capital injection, or you're going to have to take over, you're going to have more loans. Why? You've got to fund that operation. Well, if we take maybe a practical example of that we find that might be helpful, we find particularly helpful, is to what would happen if you lowered your transfer price in this case? Well, if we go from a $5 million loss to just break even, we're lowering the amount of tax that's paid in Japan, and we're utilizing our losses on the US side. So Immediately, there's some tax savings because you're not overpaying tax in Japan anymore. You don't have to borrow as much money because, well, there's at least self-funding the operations, and that cuts down the amount of loans you have. So all those things are important when you're trying to do everything else in bringing costs out of your supply chain. So what are some benefits? Well, we'll talk just to summarize. Correct transfer prices reduce your audit risk. Correct transfer prices often reduce the taxes payable on a global basis. And those global correct transfer prices also improve cash flow. So one thing that we talk about when we're discussing issues like this with our clients is, well, hey, how much taxable income is being earned by country? If there's a loss, we probably can improve that, both from an audit and cash flow perspective. How much tax is paid by country? That helps you manage what the risks are by country. And then maybe correcting those transfer prices can save you both from a global effective tax rate and cash flow needs. Again, saving a lot of heartburn over the long run when it comes to running your operations. So with that, I will turn it back over to Vince and Karen. Just talk about importers.
Thank you, Alex. That was excellent. And the star of the show, as far as I'm concerned, the transfer pricing topic. So
You're very kind.
that's excellent. Not going to spend a lot of time here. One slide for importers, one slide for exporters. So headwinds. Early this year, there's a group of headwinds for companies, right? Interest rates, possible recession, supply chain, labor, increased expenses, and last but certainly not least, getting paid. So banks have solutions to help companies get paid, standby letters of credit, and other solutions. We can advance to the next slide. This is simply a slide for exporters. I imagine this deck will be available. I'm not going to go over one by one. Key points here for exporters: reducing days sales outstanding and mitigating risk. Again, getting paid. And the next slide. Here, very nice arrangement showing where your highest and lowest risks are. We see in our space letters of credit used, commonly used to cover the risk of a contract party. And it's a guarantee payment when a seller ships goods, typically to their international buyer. So that's just really the point here to manage between the highest and the lowest point risk. With that,
if I can interject real quick, I mean, that I think it's great to point this out because it's wonderful to find low cost suppliers, but if you don't have a letter of credit, for example, it doesn't matter what the cost of the products. If you're not getting them, you've got a much bigger loss than what you had before.
Dale, Alex, I'm so glad you said that, because actually I meant to make a comment about performance assurances. So for exporters, I recently had a client that set up a standby letter of credit for a buyer out of Jamaica, and they wanted basically, certainty around their work and delivering on the contract. So exactly, it just introduces certainty to an arrangement between two parties who don't know each other that well.
And it's great that you can help facilitate that relationship. Even you're putting two together and helping facilitate that transaction.
All right, and this is where I jump in, and I'll be quick because we're getting a little long here. So very simply, on receivables, what do companies need? Well, clearly they want to collect faster. If they have to finance, then they want to reduce those borrowing costs. And really, we want to help make it easy to do business. Look at the Uber model, right? They reduced payment friction, and that stimulated sales. all else equal, if you are easy to do business with, if you accept payments in a way that customers want to make those payments, if you accept payments in their local currency, these are all considerations to make it easy to do business with, and all else equal, you will do more business. So it's helping reach deeper into existing markets, and it's helping develop new markets. On the payable side, you want to extend your days payable outstanding without falling out of terms. The easiest example there is a letter of credit. Use a letter of credit instead of paying advance, right? If you're buying product from China, a lot of times you have to send your wire with your order, you know, a portion of it with the order and a portion before it ships, or maybe after it ships, but before you actually get the product. Inventory, you're looking to improve turnover and return on assets. You need to increase visibility and forecasting. You need to know when you're receiving that product. And if you don't receive it on time, we keep coming back to a letter of credit, but a letter of credit will bring the buyer and the seller back to the table because these are defined payment terms. And if those terms aren't met, then they have to come back to the table and renegotiate and amend that letter of credit in order for that payment to happen. So it gives you certainty. You want to expand or replace your supplier base. We talked about nearshoring or reshoring. New relationships have risk. And how disruptive would one delayed shipment be for your business? Either, you know, it doesn't show up at all, or it shows up late, right? Okay, next slide, please. So this is a cash conversion cycle example. This gives some of the why of what we're talking about and how large companies manage their liquidity. Growth takes cash, right? You've heard the term grow broke, okay? If you have receivables, payables, and inventory turns that is more than 1 day, when you grow, it takes up cash. So this is a master of the obvious statement, but companies should try to collect faster, pay slower, and turn inventory quicker. But how do you quantify the impact? Okay, so let's take an example here. $10 million revenue company, $27,000 revenue per day. They have 30-day receivables, 60-day inventory turn, and 30-day payable, which nets a 60-day cash conversion cycle. If you take the 60 days times the $27,000 per day, that's $1.6 million tied up in working capital. In this example, they're leveraged 3 to 1. Okay, that's a reasonable leverage rate. The cost of debt, 7.5%, kind of using a generic today's rate. And equity, if you were to invest in a small business, you would expect at least a 20% return. Okay, so next slide. So what happens? If we can eliminate 1 day from that 60 days, every 1 day is $27,000 of additional working capital, which at the weighted average cost of capital, that was on the last slide, about 10%, is $2,800 of annual capital cost per day. So if you're able to shorten your cash cycle by 15 days, that's additional liquidity of $405,000, and the annual cost of that liquidity or that capital of $405,000, right? So this is material. What is your opportunity cost with that $400,000? Sure, you could certainly pay down loans, but what if you're not borrowing, right? Could you make an investment of that $400,000 and get a better return than just having it tied up in your cash conversion cycle? I think it's pretty safe to say you could. And then just the last slide, I'll just make a reference here. You know, it's not a B of A commercial. It's just saying your bank should have resources in the markets that you do business, at least access to resources. So whether it's letters of credit, whether it's financing, whether it's foreign exchange, there's a lot of things banks can do to help facilitate those transactions. I think it's important to know where they do business and can they support you in those markets. And with that, we are wrapped on the banking portion.
And just Vince, just to interject there as well. I mean, it's not just unrelated companies that, you know, the banks can help facilitate things. It's also between related parties because, you know, just having those payment terms right and fit well with your business line, it really does save a lot on cost of capital there. Tell you, we have a couple real good questions here. I guess if I can just to put things to put things in a bow here. The main thing here is that we just want to emphasize that you can generate a higher return on your investment if you've got the cash in the right places and the cash in, and you're paying the right amount of tax, and you have cash where you need things to make investments. So if I'll, the first question here is, who administers transfer pricing for each country? Well, effectively, every tax authority around the world enforces transfer pricing rules. And what they are from a very high level, they want to make sure that if you're, let's say, for example, a US company, they want to make sure that you are not putting too much profit in your subsidiaries or your sister corporations. Conversely, the countries, the tax authorities where the subsidiaries are, they want to make sure they're getting their fair share of tax. They want foreign-owned companies, whether it's the US or elsewhere, to pay tax of some sort. The amount of tax is going to differ depending on the industry. That being said, if you have highly variable profits or you're incurring losses, you're probably going to have some more questions from a tax authority than not. For many tax authorities, transfer pricing comes up as part of a regular tax audit. All right, let's see, who else? Is there a best practice for charging management fees? Short answer, you know your business best. And it really comes down to how big are the charges. If you have $5 million worth of charges, you probably want to have a relatively scientific way of allocating those costs out. So for example, if you incur marketing costs for the entire globe in your headquarter company, maybe you want to allocate those costs out by net sales as a proxy for how much, how valuable those services are for your subsidiaries. So there are a number of allocation keys, but it really depends on the type of services that's being rendered and also how your company operates day to day. That being said, you've got a real good, you know your business best, and quite often, if you've shown that you've thought about it and come up with a strong rationale for those service charges, you're going to be far better positioned than most other companies, and also in a tax audit. Other questions?
Can I just comment, Alex? We started out talking about examples about inbound, like a US subsidiary, et cetera. A lot of these same considerations apply outbound, and Michael Jameson, your questions, are talking about charging US management fees for your by your US primary entity to our international subsidiary. And we've had this conversation before, but we always want to be cognizant too of managing the limited liability. I know there are a lot of financial and banking concerns on this call, and tax. However, we want to make sure that you have limited liability and that you don't do something in a direct relationship on the management side that actually skirts the limited liability structure and makes you subject to tax directly in that other jurisdiction. So you want to go through your structure when you're charging those fees. One thing I've commonly done with Dale is if you have the mothership in the U.S., you may want to drop down and do Mothership International Holdings as a subsidiary entity just below that, as long as that comports with Alex and the bank and everyone else and tax to flow through that structure, because if the foreign tax entity, and I've had this happen before, decides they want to audit your U.S. operations and find out what percentage of your U.S. mothership actually relates to Zimbabwe, wherever you're working, or Brazil, or wherever, then we would like to have them have at least a hard stop right there at that drop down below, if possible. And it's not a guaranteed a thing, but we at least want to have the argument and work on that. Alex, or Dale, do you want to comment on it? It does require a little more. Sometimes you have to have separate bank accounts for that drop down entity, et cetera. So that's a little more legwork with Karen and Vince, but that in the end, you want to protect your limited liability.
And I think just to add to that, in terms of best practices, we strongly urge, regardless how you handle your international businesses, you should have an intercompany contract specifying roles and responsibilities in the U.S. versus other subsidiaries, or vice versa. That helps explain to a tax authority how things operate, and also provide some governing provisions with respect to how you run things day to day. The second thing, and this is maybe more a transfer pricing issue, is you want to have intercompany invoices when it comes to management fees, goods, services, what have you. That also helps support your position and also helps facilitate getting products or services or royalties from point A to point B. So great points
if I could add here, you need, if there's a loan, you need a promissory note. If you're licensing your name, you need a little license, or even if it's an omnibus agreement that talks about multiple things, consulting, everything else, but you need to have documented that if maybe you have a consulting agreement, and the goods and so document, of course, and the contemporaneous nature of when did you decide that the rate was going to be this and that is probably going to be important to the taxing authorities as well for transfer pricing, right, Alex? Not tomorrow when they knock on your door and say, why did you decide 10 years ago? You need to have done that analysis contemporaneously when you set that rate.
Dale, did you want to add anything, or?
Yeah, there was one thing that, I was speaking mostly about inbound, but for exbound, for exporters, there's a special entity, a tax entity called an IC DISC. It's a domestic international sales corporation.
Domestic corporation. Sorry, it's been on my mind recently. Go ahead.
Yeah, so if you're doing significant exporting, that entity would save you lots of tax dollars. I just want to throw that out there because that's sometimes people aren't even aware it exists, but it's a significant tax savings tool if you do significant exporting.
All right.
What was the name of that? Sorry.
IC-DISC, DISC.
Thank you.
We only have a couple minutes here, Doug, if you wanted to add any closing remarks, but I guess from my perspective, guess we're putting a lot of different issues on the table, but if I can emphasize, you're not the first person who's ever come across this issue, and it's very common to get lost in some of the minutiae here, but one of the great things about being Global Chamber is that there's a lot of resources out there for you to help figure out the best way forward for you, and you don't have to go it alone and have some heartburn that something down the line is going to bite you.
Sure. Yeah, and that's kind of one of my key takeaways from this. It was a comment that Mike made about how frequently he gets together with Dale and they have a joint call. And my own experience working in a multinational and in other companies is the mistakes get made when there's a functional decision without conversation across different people with different expertise. And so what's to me very compelling about all five of you together in one room is that, you're having this conversation and you're building off of each other. But what happens very often in a company is the CFO makes a decision and, quite honestly, clueless about, marketing or sales or other issues. And, and I'm pointing out to CFOs because I've been screwed so many times by CFOs over the years by making decisions about pricing or whatever, that were so wrong and so painful that, I have the scars for a lifetime. And so my question, sorry for the long lead up, is how do exporters, how do companies, how do C-level folks pull together their team or pull together you in a way that allows that rich conversation to occur that we saw today, so that those functional siloed decisions don't sink the ship or cause me or others pain? How do you each view that question?
Can I jump in on this one because I have an opinion on this one? There's my experience, companies will try to figure out their own path and then come to the service provider and say, here's what we need. And I think a more effective approach is to say, here's what we're trying to accomplish. Can we have a discussion about this? And can we talk about the risks and the opportunities? That's a much more collaborative discussion. And I think we get pigeonholed and we get very narrow when the company that doesn't have the experience doing this comes to the bank, the CPA firm, the attorney, whoever, and says, here's what I need. Because then you kind of end up getting focused on that.
Yeah, that's a huge epiphany. Thank you. That's a great idea. Thoughts?
I agree. I think what I see is that the hesitancy is to get a bunch of professionals charging collectively over $1,000 an hour. Obviously there's a hesitancy to do that and do it very often, but I think there's a need for it in certain circumstances. Like when you're trying to make decisions, get the key people in there that would help you make those decisions. If it's just an ongoing, we did this and check and let everybody know, then obviously you just send out emails or however you communicate. But if you're actually trying to make a decision on something important, pay the $1,000 an hour or whatever it is and do it right. And then that way you don't have to pay us $10,000 to fix it.
Yeah.
So elevate
into
more critical through that process is what you're saying.
If I could jump in too, Doug, I mean, and an important upfront decision that's made frequently is what kind of entity. We need to get it quickly. We need to open a lease in wherever we're going in the United States. We need to open a bank account, but we need that entity and the tax ID number. We need that established like yesterday. Well, all those considerations, that's where it's really valuable to have 2 or 3 people on the phone, and Dale tell them about tax, me tell them about the legal side. We pick the type of entity, we get it formed, and then we draw in the other professionals on the bank account or whatever to make that go. I would also like to add that we've had a number of situations where people are flipping their headquarters to the United States, out of the UK, out of Canada, out of other places where they have a structure here. They've already set it up with a Delaware or an Arizona entity, but they want to flip and now the headquarters be the US and now the UK be a subsidiary. And there are some tax considerations to that. It affects their transfer pricing. It affects their banking. But there's a way to do it efficiently, and we can get those done. I also would say on the outbound distribution, world distribution, they'll come to the US, set up, expand here, and now after they've reshored, now they're distributing to 30 countries elsewhere. And there are pitfalls in distribution, topic for another day. But we've found that people using credit guarantees like from the Exim Bank will enable their distributor in Brazil to do a turn. Instead of having to pay cash up front and do 4 million in sales, they can do a 90-day turn now and maybe increase their sales to $8 million a year. So it's you know, there's a lot of strategic concerns that go back to what Vince was showing, that this is real money. This is real material. It really does affect the economic side. We're not just, you know, charging fees here. It really, these decisions really help them up it.
Awesome. Any more comments before we close, please, on either on that question or any other closing comments, please?
Doug, I do
Doug,
have.
yeah.
Oh, please, Karen, go ahead.
I was going to thank you, Doug, for, you know, bringing us all together and for elevating this to start with the transfer pricing topic, which we weren't very conversant on. And, you know, what the audience has here is a group of people that generally become closely associated. We've known Mike for several years. He is an excellent attorney here in the market and highly recommend him. We've been part of the Global Chamber for several years, and that's why this meeting was brought together. And we're so fortunate to have met Alex and Dale and Alan through this process. And I would suggest that we consider repeating this topic if you get some good feedback on this meeting, Doug.
Fantastic. Great comments. Thank you. Vince, did you have something you wanted to say as well?
Yeah, I wanted to put a bow kind of on the banking side of things. That, you know, it's easy to first think about a bank as a lender because that's what we do so much. But I think the more important value that we bring is really in the risk management side of the discussion. We are on the same side of the table as our clients. We want them to be successful. We do not want them to make missteps. And I think when you approach it and say, this is what I want to accomplish, and, you know, we talk about the risks, a lot of what we do, a lot of our bank products, the payment mechanisms that we use are to manage risk. The more educated you are, the more confident you are doing business in a market, the more ambitious you're going to be and the more opportunities you're going to pursue.
Fantastic. You've listened to just a really great discussion today. Karen Bottesch, commercial banker and senior vice president of Bank of America. Vince Thelander, business banking marketing executive, also at Bank of America. Alex Martin, who's the principal and transfer pricing practice leader at KBKG. Mike Patterson's a partner at Spencer Fane, and he works in the areas of business, corporate, M&A, securities, and definitely international. He's Mr. Global and unstoppable. And Dale Walters, who's director of Canada-US Tax Services at Beach Fleischman. I think we've all learned something today. Thank you all for taking the time. Thank you for listening. We will do another program like this undoubtedly, and we definitely would love your feedback as well. Thanks, everybody. Have a great rest of your day.
Thank you, Doug.
Thank you, guys.
Thanks, everyone. Have a great one.
Take care.
All right, bye.